As of the market close on Friday, November 14, 2025, Ondas Holdings, ticker ONDS, finished the session at $7.18 per share. That move represented a very strong gain of 9.45%, or 62 cents on the day. Now, with the weekend upon us and trading halls quiet, the immediate reaction for many investors seeing a nearly 10% single-day pop in a small-cap tech stock is to be deeply skeptical. The assumption, the broad market expectation, is that this is just noise. It's volatility. It's a low-float stock being pushed around, perhaps by a rumor or a technical bounce. This is what we're conditioned to believe, especially after a stock has seen a 52-week range stretching from a mere 57 cents all the way to $11.70. It looks, from a distance, like a trader's plaything, not a serious long-term holding. But that expectation, in this specific case, is fundamentally wrong. That 9.45% move on Friday isn't the story. It's the aftershock. It's the market still failing to properly price in the explosive news that dropped 2 days ago, a development that suggests the entire narrative around this company has been reset. What most of the market is just catching up to, and what that 9.45% jump reflects, is the follow-through from the company's third quarter 2025 earnings report. To call it a beat is an understatement. Ondas reported quarterly revenue of $10.1 million. The expectation from analysts? Around $7 million. But the truly staggering number is the year-over-year comparison. In the same quarter last year, Ondas did $1.5 million in revenue. This isn't a 20% or 50% increase, it's a 582% increase. That is the kind of figure that forces even the most cynical institutional desks to stop and reread the report. The entire game changed for Ondas this past week, and that 9.45% gain is just one part of a violent re-rating. The expectation was a small, struggling tech company. The reality is a company that just posted a 0.5% growth rate. This isn't the kind of stock you trade flippantly on the Robinhood app. This is the kind of stock you need to pull the filings for on your Interactive Brokers terminal. But it gets deeper. The numbers that truly matter, the ones that are driving this sustained buying pressure, aren't just the backward-looking ones. It's the new guidance. Management didn't just nudge their forecast, they took a sledgehammer to it. Ondas raised its full-year 2025 revenue target from a previous $25 million to a new minimum of $36 million. That's a 44% increase in the full-year outlook with only 1 quarter left to go, implying they expect to book over $15 million in Q4, which would be yet another sequential leap. As if that weren't enough, they issued preliminary guidance for 2026, a target of $110 million. Let's be perfectly clear about what that means. They are signaling an intention to grow from $36 million in 2025 to $110 million in 2026, another 3x in revenue. This is the kind of forward-looking statement that changes a company's entire valuation multiple. This is why Oppenheimer upgraded the stock to outperform with a $12 price target, a figure that suggests significant upside even from Friday's closing price. The market isn't just reacting to a good quarter, it's reacting to a new, multi-year growth story. This is a different animal than a blue-chip dividend play you'd find in Fidelity mutual funds or a stable value holding in a Schwab Intelligent Portfolios account. So what is actually happening inside this company? For years, the general belief about Ondas was tied to its legacy business, Ondas Networks. This division is focused on providing private wireless data solutions for critical industries, most notably the 900 MHz spectrum for Class 1 railroads. This is a complex, high barrier to entry field, but it is also one defined by incredibly long sales cycles and slow, regulatory-driven adoption. The expectation was that ONDS was a long, patient bet on the eventual modernization of railroads. But the reality, revealed in the Q3 report, is that this legacy business is now a sideshow. Of the $10.1 million in revenue, $10 million, virtually all of it, came from their other division, Ondas Autonomous Systems, or OAS. This is the division built through acquisitions like American Robotics, Aerobotics, and the more recent Apeiro Motion and Centrix. This is the new face of Ondas. This OAS division isn't selling railroad spectrum. It's selling high-tech, AI-powered defense and security platforms. We're talking about the Optimus Drone-In-A-Box system, the Iron Drone Raider counter-UAS or counter-drone platform, and advanced ground robotics from the Apeiro acquisition. The 582% revenue growth wasn't from a railroad. It was driven by deliveries of these systems to military and public safety customers. This is a pivot so sharp, it's almost a different company. The stop many investors thought they knew, a slow-moving infrastructure play, is now, in reality, a high-growth defense and autonomy company. This business is moving at a completely different speed, and it carries a backlog of over $22 million, giving it visibility into future quarters. This isn't like analyzing Tesla stock based on car deliveries or Apple stock based on iPhone cycles. This is a business-to-government model, where contracts are large, lumpy, and incredibly sticky once you're in. This is the kind of high-stakes online investment that requires a new level of analysis. Now, we have to ground this in financial reality. A 582% growth rate is fantastic, but at what cost? This is where self-investing requires looking past the headline. Ondas is still not profitable. The company reported a net loss of $7.5 million for the quarter and an adjusted EBITDA loss of $8.8 million. It is burning cash to achieve this growth. This is the central tension of every high-growth story. But here, too, the reality is more complex than the expectation. The expectation would be that this cash burn is a ticking bomb time. The reality is that Ondas has spent 2025 building one of the strongest balance sheets in the small-cap autonomy sector. Through a series of capital raises, the company now sits on a massive cash pile. While one source notes a cash balance of $433 million, other reports and company statements have pointed to capital raises totaling over $850 million this year. This war chest completely changes the risk profile. It means they don't have to go back to the market cap in hand in 6 months. It means they can fund their operations, fund their R&D, and even make more strategic acquisitions to fuel that $110 million revenue target for 2026. They have bought themselves a multi-year runway. This brings us to the risks, because no 9,000-character analysis is complete without staring at the bear case. And there is a very significant one. Buried in the reports is a crucial detail. One article stated that 90% of the quarter's $10.1 million in revenue came from a single customer, a large military and public safety contract in Israel. This is the definition of extreme customer concentration. The bullish reality of 582% growth is immediately challenged by the bearish reality that their entire quarter was made by one client. What happens if that client's needs change? What happens if a competitor underbids them on the next contract? This is the kind of detail that traders on SoFi Invest might miss, but it's the first thing a professional analyst at Fidelity Wealth Management would circle in red. The entire bull case for Ondas now rests on its ability to leverage this massive initial contract into a diversified global customer base. They need to prove this isn't a one-hit wonder. This is the question that will define the stock's performance moving forward, far more than any single-day 9.45% move. The future outlook is a story of execution. The catalysts are clear: converting their $22.2 million in backlog into revenue, signing new major defense clients in the US and Europe, and successfully integrating the technology from Apeiro and Centrix. They have a new partnership with Palantir to use its Foundry platform, which is a massive validator and a tool for scaling their autonomous data. They also have a deal with Rift Dynamics to be the exclusive U.S. distributor for 500 WASP drones, targeting an urgent need from the Department of Defense. These are all huge potential tailwinds, but they are all running against the risk of that customer concentration. They are also running against the challenge of integrating all these new companies and technologies into a single cohesive platform that a military client can rely on. This is where many companies fail. With that in mind, I'm curious what you all think. With 90% of their quarterly revenue coming from a single military customer in Israel, does that massive concentration risk scare you off? Or do you see it as a beachhead for massive defense expansion? Comment below with your take on this concentration. So, as we close the books on this week, that 9.45% jump to $7.18